welcome to Money Matters TV. My name is Doug Hepburn with Hepburn Financial Advisors in Phoenixville, Pennsylvania, and I'll be your host today. We offer securities and investment advisory services through Cetera Advisors, member FINRA SIPC. Cetera is a registered investment advisor and a broker-dealer and is separately owned from any other named entity. I'd like to welcome my co-host today, Ken Jordan of Princeton Mortgage. Ken,
how are you today, Doug?
World? I'm doing great, thanks. How are you?
Fantastic. Happy New Year.
Same to you. Same to you. Tell me, does the new year bring anything different in the mortgage world? Any changes?
It sure does. It sure does. Every year we look for the increase or decrease or no increase at all on what we call the Fannie Mae, Freddie Mac, the agency loan level, the agency loan limits, for single family housing. And we did get an increase this year. We got an increase of about $79,000. So our new conforming loan limit is $726,200, which is pretty substantial. When I got in the business, and I might be dating myself, when I got in the business, the jumbo loan started at $275,000 and up.
Wow.
So anything below 275 was considered a conforming loan, and now that number's jumped to 726. And what's interesting is that I just did some quick math, and you can actually buy a $748,000 property as a first-time buyer and only put 3% down, which is
holy cow.
Man, and we also got the increases in the FHA loan limits too, which is very common first-time buyer product. Again, typically for people who are putting little to no money down or very little money down, and that is actually up to $529,000 for this metropolitan area, which is never thought I'd see the day that the FHA loan limits were over $500,000.
Yeah, gosh, with that kind of growth, people are going to be bringing cash in wheelbarrows to go buy a house. I guess that's better than buying a loaf of bread with it, right?
Well, a loaf of bread only lasts so long.
Yeah. Well, that's interesting. I know we saw some.
So what's new in your world?
Well, we've seen a pause in interest rate rises. Not really a pause, but just a slowdown. If everybody's anticipating the Fed's going to be raising by 50 basis points, and we did see that back in December.
Yep.
Question is whether or not that's going to continue and if inflation is rolled over. But, as I'm sure inflation drives the FHA loan limits, it also drives a number of different limits that Congress has enacted on everything from tax rates, Social Security. I mean, we got the largest bump in Social Security in a long time. This year, people are experiencing that, but also, it's retirement deferral rates. So this year, you can actually put $22,500 into your 401k, 403b, or 457 plan, or even a.
What's that up from? That's up from about 17 and change. Is that right?
Over the past couple of years, it's crept up, but this past year was a big jump. Yeah. So. And now the catch-up contribution is only still at $7,500, but it means that people can put $30,000 away. So that's huge.
Yeah,
it's really huge. Defined contribution limits went up a little bit. The maximum is $66,000. So, for example, if you have a SEP IRA, you can either put a maximum of 25% of your income or 66,000 in there, excuse me. It's so there's a lot of things that have moved up. The Social Security wage base has gone up. So, people are going to see, they're paying Social Security tax up to $160,200. So I know some people will, look forward to that point halfway through the year where all of a sudden, bang, their paycheck gets bigger because they're not getting Social Security taken out anymore. Well, that's probably going to be a little bit longer now. until that happens, maybe a week or two. But everything is going up with the inflation rate, and that's been something we've been talking about for a long time. But now it's starting to creep through a lot of these limits that are put out by the government that drive federal spending, but also drive tax benefits. So it's best to look at your retirement plans, make sure that you can maximize those amounts if possible. And it's created an opportunity for those people who need to save more.
Now, you were saying, we were talking earlier, something was on the horizon here, something that you wanted to give everybody a sneak peek on.
Well, it's not really on the horizon. It's actually here. But, if anyone was paying attention to the news, they saw that, the government nearly shut down. And but at the last minute, Congress came to the rescue and signed a $1.7 trillion omnibus spending package.
1.7 trillion.
I know the numbers defy comprehension. But there's rumor that it might actually slow down inflation. I don't believe that, but that's what they're trying to tell us. I'm just kidding. The reality is, it's just a 4,000-page bill, and in that bill, they snuck in some adjustments to retirement plans, which are actually pretty good. And I think, we'll see a lot more of that. We'll probably go into more detail next month on it. But a couple of years ago, they passed the Secure Act, which stands for, and I love it when Congress does this, they come up with these acronyms, is setting every community up for retirement enhancement. And, well, they just did that Secure Act 2.0, which is adjustments to all the stuff they did 2 years ago. And we'll get into more details in our next show. But starting in 2023, required minimum distributions are going to increase at the age at which you have to take those. So it used to be for years that at age 70 and a half, you had to start taking money out of your IRA because, what the government giveth, the government taketh away. If you get a tax deduction now, you're probably going to pay tax on it later. Well, when you put money into a pre-tax, into a retirement plan, Congress they got to get their tax dollars back. So they had it so that you had to start taking money out at age 70 and a half based on actuarial tables. Secure Act 1.0 increased that to age 72. So some people didn't have to take RMDs for the past 2 years. Well, now they've increased that to 73 for starting in 2023. And it's going to increase to age 75 over the next 10 years. So it's a gradual increase, but for those people who turn 74 in 2032, they'll be able to wait until age 75 to take their required minimum distributions out. And, it just allows people to save that money a little bit longer because we're living longer and people need that money to last longer. And if you're forced to take it out because of the tax code, you may end up depleting your savings when you really need them in your older years. So that's probably one of the biggest things.
Lots of stuff going on.
Yeah, there's lots of stuff. One of the big ones that I really want to dive into later is the fact that you'll be able to take money from a 529 plan and roll that over into a Roth. But that's a little more detailed.
Sure.
But we've got some great stuff today. In fact, we've got a great guest coming up. But we actually had a question from our audience that's really akin to your bailiwick. Tom Leonard from Philadelphia asked, whether the Fed has gone too far with raising rates. What do you think of that?
Whew, that's a tough question to answer. I tell you what, our guest is going to give us some very good insight as to whether or not the Fed went too far or is going too far when it comes to raising interest rates. But unfortunately, time is the only thing that'll tell that story. We'll know if the Federal Reserve is able to put us into a mild recession or if we're going to plunge into a deeper recession. That remains to be seen. I think our guest has some opinions on that too, which I'm very excited and eager to hear their answers on. But yeah, it's just it's one of those things that the lagging indicator is the problem. We won't know until we know. So wish I had a better answer for you there, Tom. But in my opinion, I think that they may have waited too long to begin raising interest rates, and as a result, they may end up overshooting. But that's just my opinion. I'd like to hear what our guest has to say.
You know what? That makes perfect sense. And as you alluded to, hindsight's 2020. We won't know until we know. Although, it seems as though they're starting to slow down the rate of increase, which could possibly be good. But, we're seeing effects of the increased rates in the housing market. So, we won't know until we know. Well, I'd like to on that note, if you have a question, here's how to send your questions to Money Matters TV.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Well, as Ken mentioned, our next guest is probably going to have some good insights as to whether or not the Federal Reserve has raised interest rates too quickly and if they're ready to stop. I'd like to welcome Vahan Janjigian of Greenwich Wealth Management. He's the Chief Investment Officer and a PhD. Vahan, how are you?
Thanks for having me on.
What do you consider the biggest risk in the market right now?
Oh, definitely the Federal Reserve. I absolutely agree that the Fed has made a lot of mistakes. They've kept interest rates too low for too long. They kept them at basically zero when it was clear that there was no more need to do that. They needed to raise rates for a number of reasons, not just to prevent inflation, but also to have some ammunition in case the economy slowed down again. But they kept it too low. And then now all of a sudden they're raising rates, and now they're raising rates too quickly. And in my opinion, they've gone far enough. I don't think they need to raise rates anymore. There's plenty of evidence that inflation is coming down. But I think the biggest risk is that the Fed may continue to overreact and raise rates much higher.
So, question. So, Vahan, it's great to have you here today. So, Chairman Powell says interest rates will go higher for longer, and it's obvious that you think that may. Or do you agree that they made some mistakes, but do you think that they need to continue to increase interest rates in order to fend off, the inflation, or do you think that they, to our guest, our viewer, do you think they're overshooting?
I think they're overshooting. So yes, you're right. Chairman Powell keeps talking about raising rates higher for longer, and I think it's okay for him to threaten that, as long as he doesn't actually do it. But I would say 3% inflation is actually a good target. And if we get down to there, I think the Fed would consider that a win. But I don't see any need for them to raise rates anymore. We have so much evidence that inflation is already coming down. They've already, pretty much decimated the housing market. And the only thing they're looking for is for more people to lose their jobs. I think that's what will make them happy.
Yeah, I know, and that's an interesting point, because the real concern is that, as inflation picks up, people demand more in wages, and you begin a wage price spiral, and that's usually means that inflation is firmly embedded into the economy, and it's very difficult to stop. I don't know that we're there yet, but when you have the labor shortages that we're currently seeing, the potential for a wage price spiral is exacerbated. So,
well, I don't actually agree that there's a labor shortage.
really,
The solution to a labor shortage is more immigration. We have a very low participation rate. There are plenty of people.
either that or productivity improvements through
Correct.
technology,
Yes,
right?
that's right. But we have plenty of people who are choosing not to work. Yes, the official unemployment rate is low, but the participation rate is incredibly low too. And what that means is that there are a lot of people who are choosing not to work. Now, historically, the participation rate is related to people retiring. So that does explain part of the decline in the participation rate, but it doesn't explain the entire thing. There are too many relatively young people, especially ever since the pandemic, who have decided not to go back to work. Now, part of the reason may be because of all of the handouts that Congress gave during the pandemic, and a lot of people saved a lot of that money, so they don't really see the need to go back right now. But eventually that'll run out, and we'll start seeing people coming back into the workforce.
So, if with regard to the employment rate being part of the Fed's plan for their interest rate, strategy, it would be difficult to get that unemployment rate up, especially as that money runs out, because you'll start to see more and more people participate, right?
Well, the unemployment rate will go up if more people participate, because remember how it's calculated. The unemployment rate is calculated by asking people if they have a job, but also if they have looked for work in the past 4 weeks. So if you don't have a job, you're not considered unemployed unless you're actually looking for a job.
Understood.
So as more people start looking, that unemployment rate will go up, even if nobody actually loses their job.
You actually have to be participating in the labor market in order to be counted. And those people who are sitting on the sidelines, collecting transfer payments or subsidies, they're not necessarily considered participating.
Correct.
Okay. That makes a lot of sense. So, I mean, what are your expectations for a recession? Do you think we're going to see one this year?
Well, I actually think we had one last year. If you look at the economy last year, first of all, the first 2 quarters we had negative growth, and that satisfies the classical definition of a recession. But in the United States, recessions are actually declared by the National Bureau of Economic Research, and their definition of a recession is somewhat different. I mean, their definition of a recession is a slowdown in economic activity that is spread across the economy lasting more than a few months. And we had that last year. So we had, in my opinion, a very mild recession. We don't know it yet because the National Bureau of Economic Research doesn't declare recessions until about 6 months after they've already ended. So we may find out sometime in the near future. As far as 2023 is concerned, I think a recession this year is also possible, but I'm not expecting a severe recession. I think we can get by with a very mild recession.
How do you think the energy sector is going to play into those calculations? We know that the energy sector was hot in 2022, partially due to inflation. I guess, costs are up. What are your thoughts on the energy sector in 2023?
Well, as an investment, I'm actually avoiding energy now. I had loaded up on energy about 3-4 years ago when energy stocks were, being avoided by everybody. They were incredibly cheap. And I tend to lean more toward value investing rather than growth investing. So I had loaded up on a lot of energy stocks. One of my favorite investment tools is the XLE. It's an ETF of energy stocks. But now I'm actually trimming because I think energy has run up too high. We had a long period of time where oil prices went up, but energy stocks did not go up. And then all of a sudden, energy stocks surged. They caught up to the oil prices, and now oil prices seem to be going back down too. Let me also say that, when oil prices go up, that does cause inflation, but that's one of the reasons why the Fed focuses on core inflation. In other words, they ignore things like energy and food, not because they're not important, simply because they tend to be extremely volatile, and they really want to focus on the rest of the economy.
And that makes sense. That if you're going to pick some sort of bogey to target, you want it to be something that's going to be relatively consistent. Yes,
Right.
something that moves, but not something that's moving every other day, like energy. You mentioned that you're more of a value investor as opposed to growth. And for some of our audience members, they may not understand value type stocks versus growth type stocks. Generally speaking, can you go into that a little bit?
Sure. Yeah. So there are things known as price multiples that investors often focus on. I'm sure everybody's heard of the PE ratio or the price to earnings ratio, but there are also other multiples too. You can look at price to cash flow, price to sales, and things like that, price to book, for example. So value stocks generally have low price multiples, whereas growth stocks generally have high price multiples. The reason is because growth stocks are growing earnings or are expected to grow earnings at a higher rate than value stocks. But what often happens is that investors get very excited about these stocks and they start bidding up their prices, much higher than is really justified. So you end up with a situation where growth stocks can be very expensive and value stocks can be very cheap. Now, if you look at investing over the long term, over very long periods of time, it's very clear that you're much better off investing in value stocks. However, if you are a shorter term investor, it really pays to focus on what's known as momentum. And growth stocks are the ones that exhibit the greatest momentum. So in other words, if you're using the stock market as a casino and you're placing bets, then I would say, yeah, go play the momentum and buy the growth stocks. But if you're a
Right.
true investor who's trying to make money over the long term, you really need to focus on value.
Yeah,
So
it's interesting that you bring that up, because I know, and this may be true, a recent memory for some of our audience, but back in the early 2000s when we saw the tech bubble burst. Prior to then, everybody wanted to be in growth stocks. Everybody was jumping into growth stocks, and value stocks, nobody wanted them. But once the tech bubble burst, the momentum or the money started to shift back into value, because people wanted to receive dividends while they were waiting for stock prices to recover.
Yeah, absolutely.
Is that consistent with your investment philosophy?
Yes, it is. So I do like stocks that pay dividends, but you should never buy a stock simply because it pays dividends.
Right.
I use a very conservative discounted cash flow analysis to determine what a stock is worth. So if you notice what happened in 2022, value did outperform growth, primarily because interest rates were rising. And growth stocks are the kinds of stocks that are expected to have cash flows in the distant future. And when you discount those cash flows at a higher interest rate, they become worth less. So that's why value outperformed last year. Now we have a situation where value is actually getting some competition from treasury securities. So as you said, a lot of people like to have dividends, but now you can get a 4.5% yield on a 6-month treasury. So that does give value stocks some competition. So what I'm doing for many of my clients, especially the very conservative clients, is for the first time in a decade, I'm actually buying some treasury securities so that they can have that income. I'm keeping it short term, but I'm also using dividend paying stocks for longer term investments.
Interesting. I know, and that makes a lot of sense, just because, and with interest rates as low as they were, anybody who was a fixed income investor was not really getting any return on their investment. Fixed income was really just ballast in the portfolio. Now that interest rates are starting to normalize, if you will, those people who are on fixed incomes can actually receive a return on their investment. I mean, I was surprised. I saw a long-term savings account offering over 3.5%.
Yeah, a lot of people also forget that the Fed did a real disservice to retired people in the past. When they drove interest rates down to zero, they really punished conservative investors who tend to be retired people who are saving their money and putting it in things like CDs and bank accounts, and they want to avoid the stock market. And so they drove interest rates to zero, and these people couldn't earn anything. It forced many of them to go into the stock market. Unfortunately, now that the Fed is raising rates, the market has been coming down. So these people are getting hit twice.
Speaking of coming down, Tesla was a pretty closely watched stock in 2022, and it took a nice big hit. Do you think it will recover?
No, I am not a fan of Tesla. In fact, I caught some grief recently on CNBC because of my views on Tesla. So Tesla, I think, is an outstanding company. I really like their products. They've done a great service to the world by really making a market for these electric vehicles. However, it's still a very overvalued stock. I mean, Tesla right now is selling about 1 million cars per year. Ford is selling about 5 to 6 million cars per year. Yet Tesla is worth about 8 times as much as Ford, which makes absolutely no sense. Now, Tesla will grow that number, so I think Tesla should actually be priced more than Ford. I think it should be worth maybe 3 or 4 times Ford, but not 8 times Ford. So I think Tesla is still a very overpriced stock, and I personally wouldn't touch it.
Yeah, I can appreciate that. With a lot of people have a tendency to crowd into what's hot, and as you alluded to earlier, when things get overbought and prices get run up, they oftentimes the pricing mechanism doesn't necessarily make sense. What are you looking at in terms of capital market assumptions, and what I mean by that is expected returns for 2023? Because I think that's what a lot of people are thinking is that, hey, we had some good years. Last year was terrible. Are we going to see markets bounce back, or is it really just going to be sideways?
I actually think the market in 2023 will do much better than many people expect. Right now, if you look at the Wall Street strategists, their consensus estimate is for the market to go up approximately 6% this year. And if you look at throughout history, one thing you learn is that the consensus is rarely correct. The market typically does much better or much worse than the consensus. I'm betting on better. I think the market could go up at least 15% this year. I think there are good reasons for that. For example, I think the Fed is going to stop raising rates soon, and that'll give the stock market a nice boost. I also think that earnings are not going to take as big of a hit as many people are forecasting. I think many corporations will continue to do well. Remember, China also just lifted its zero COVID policy. I know that they're having a problem right now with the spread of COVID, but I think supply chains have really eased, and the global economy is starting to do better. So when I look at all of these things, I'm actually growing a bit optimistic. Believe it or not, even though I am a value investor, I'm also getting a little bit attracted now to some of these growth names that just absolutely got decimated last year. So, for example, for some of my clients, I recently just added a little bit of Amazon and a little bit of Alphabet. Now, these are very, very small positions for me, and
Right.
I do expect them to go lower. In fact, I hope they go lower because I would like to buy more. As Warren Buffett said, if you really like a stock, you don't want the price to go up. You want the price to go down so you can buy more.
Exactly.
And so
Well,
because
that's fantastic stuff. We really appreciate your insights, Vahan.
Well, thank you.
I'd like to thank you for being our guest today. This is very informative, and we look forward to hearing from you again in the future this year to see whether your predictions have panned out.
Well, thanks for having me on.
Yeah. And thank you, our viewers, for tuning in. Our next week's show is going to be, our guest is Louis Casa III, MPA, CEO of the Baruch S. Blumberg Institute. In the meantime, we appreciate you watching, and always tune to Money Matters TV because your money matters.